Good morning, everybody. This is John Person, and we are going to begin our weekly regular scheduled planning and scanning. And of course, this is being recorded at the moment. What I wanted to first start off with is welcome some of the newcomers here, as well as our students as we concluded the first quarter of 2013. Interestingly, I've gotten, as you probably may have, a lot of emails over the last 3 days, 4 days, week, and I think a lot of emails are people that, I'm not going to use the word cherry pick, make some of these emails make the market seem relatively easy. And then I've gotten some other emails that said this was like a really hard, difficult quarter for traders. And I think in this trading room, what we've focused on was the health and the breadth and the market condition, and specifically focused for stocks, stocks that were entering seasonally strong periods of sectors, and stayed away from stocks that were either in a weakening sector or tried to get on the right option strategy. And some examples come to mind, and I think we do have people in this room that don't have that bad of, like me, a short-term memory where you only remember your winners and not your losers. But a current position that I have, an option strategy, is a May VXX. It's an ETF off the VIX. It's a 21-23 call spread, and I'm in it from 60 cents. And I'm looking for some volatility, and we did have a plan of a spike in volatility, which we got. We were trying to liquidate half the position. We missed it by a nickel or so to liquidate half the position, and I'm going to continue to monitor that trade for this week. So that's the bad news. The good news is we did a lot of really neat stuff in specific stock trades that did quite well. We did a lot of trades in option strategies like credit put spreads in Apple. We tried to get in credit call spreads in Google when it hit our monthly pivot resistance. And not to brag, but just to show that it wasn't as difficult of a quarter for us here at Trading Triggers University, that I don't believe that is what most of the emails that I've been getting over the last few days. So if you're like me and you're on everyone's list, or you get bombarded and you try to filter this stuff out, I always kind of get a chuckle at some of the headlines of the instant millionaires and all the insane profits that one can make and how much people have made. And the funny thing is they just don't mention how much capital was required to make these kinds of trades that made all this money for them. So I guess the bottom line is simply this. If you can learn a systematic approach to the market of what you're comfortable with in your own skin with your own capital requirements. In other words, we all do not have unlimited resources to trade. So we have to find the best strategy, or at least a strategy that will allow us to live with the risk and profit generously. And so if we can at least utilize some types of different various strategies, I think, rather than just being an all-day trader, and an all-option trader, or an all-stock trader, I think if you can diversify, I think this is the year and this is the time to learn to do that, because hedge funds are providing a lot of liquidity in the market. There's so many, 5 to 8 years ago, there were no hedge funds. Hedge funds 8 years ago wasn't really a term that anyone was familiar about. What we were familiar with was the term hedging, which usually meant to use an option strategy or to spread off a position to hedge your risk. That's what commodity markets were for. So with that said, the question is, now that we've just completed a quarter, if you look back at your performance and you could say, gee, how did I do every month? How did I do for the first quarter? 25% of the year is concluded. How did you do? And if you did okay, then give yourself a pat on the back. Because according to some, it was a difficult quarter. According to others, they made more money than they can believe. And if you take a look at a lot of different hedge funds, some found it to be a fairly difficult month. And it was more important that not only was March a difficult month, There was a lot of headwinds. It was the end of the quarter, window dressing, options expiration, quadruple witching. I mean, there was just so many different headwinds. We had geopolitical issues. We've had, I mean, all kinds of things hit traders. Fiscal cliff, government fiscal policy changes. I mean, it's just been one big news-driven event. But yet, you're staring at the S&P 500 chart in the face, and since the beginning of the year, with that one big green candle right here, it has set the tone for the market, and it has gone in what I consider a fairly, except for this 3-week period here around President's Day weekend, which typically sees corrections in the market, this was really about the only time period which maybe could have made you a little bit nervous in the marketplace that the correction was coming. If you look at the middle quadrant of the chart, what we like to start with planning and scanning is to say, let's look at the health of the market. Now, what you are looking, again, as a reminder, is a weekly chart, and this is the advanced decline comparative ratio on the S&Ps in specifics. I mean, it's specifically an advanced decline comparative ratio on the S&P 500. This is a moving average, and as you can see, we have crossed the moving average, and we've stayed above that level, which means more stocks are participating with this rally than not. Volume levels have been pretty sustainable, and at the very, which is an on-balance volume indicator here at the bottom of the next lower quadrant, and at the very bottom, this is something that I want to discuss and tap into today. This is the the commitment of traders report at the very bottom here. So, prices up here, advanced decline here, on-balance volume here, commitment of traders report here. So let's take a look at what these three graphical lines mean. The blue are the large hedge funds or traders that are speculators but hold reportable size positions. The green histogram, these green bars, represent small speculators. And the red line represents the commercials, hedgers. Now, what's interesting is you take a look of this zero line right here. Anything north of the zero line means net long. Anything south of the zero line means net short. The small speculators kind of were bullish the market and have been bullish the market throughout much of 2012. They began their net long position in March at the highs. They had been short prior to that. As you can see, they weren't really committed to the market. They finally got in and then went short the market up in here. Market continued higher. Then they went long. They doubled up. They added on. They got more long. And then as the market started to move higher, they started to liquidate their longs and start to get out of their positions. As you can see, the green histogram. And that's what I want to really focus in on, is the green histogram. They haven't really participated in the marketplace by the sense of a net long position, or as far as these green bars, it's not into the 400,000 range. If you look here, this is only 172,000, and you can see it by looking up at the top here. Notice that the net long that they went was 169,000 net long positions, whereas several years back, or even if you take a look back in June of 2012, we had 315,000 positions. So in this huge move that we've seen in the marketplace, if you think that volumes are down and if you think that people aren't participating in the market, you're absolutely correct. Because if you take a look at the commitment of traders report, small speculators, Mom and Pop America, they're not trading in the market as much as they once were. The commercials are actually at one of the largest net short positions they've been in over, as you can see, almost 3 years. So the commercials interests me because when they get on to the short side of the market, they're hedging some risks. What's going to scare me is when they decide to unleash those hedges. When they cover those hedges, that means they're pretty much committed to the point where they don't think the market's going any higher. So for me, I think it's going to be more of a view that now that we've got commitment from some small speculators to finally nibble on the long side of this breakout in the marketplace is to me telling me from a seasonal perspective, which selling may go away, we typically see some type of resistance level. It doesn't, I think that we've got another maybe week or so of some upside in the marketplace, and then after that, I'm a little bit more concerned in the market. Now, the reason I say that, and in our planning and scanning since the beginning of the year, my favorite line is, hey folks, I might nibble at some stocks, but I've never once told, and I'm more of a stock picker lately, but I've not once told this room, and we have a lot of witnesses in here, that says, sell the farm, buy puts, the market's going to crash. We have not made that call. That is one that we have not had. We are not that bullish in the market, and one of the reasons is the fact that we are seeing a nice uptrend in volume. We're seeing a nice uptrend in the advanced decline, and almost every week and every month we get a new breakout. And what I've been talking about, and one of the things that we've blogged about and talked about in this room in planning and scanning, is that I see a sector rotational type correction occurring where leadership changes. When we take a look at the NASDAQ, and this is a monthly chart, let's change this to weekly. When we take a look at the NASDAQ 100, the volume on the NASDAQ 100 has not really accelerated, nor has prices. So we're not seeing a lot of move to the upside. In fact, not all stocks have made it in conjunction or at least associated with the rally that in the broad-based market. We haven't seen Google continue to rally. We haven't seen Priceline. We haven't seen a lot of different stocks, Apple, for example, move up in conjunction with the market. I think this particular time frame, and I want you to remember the words that I'm talking about, a rotational type correction, where is it possible for the stock market, the broad-based indexes, to correct to the downside sometime in the next 6 to 8 weeks, but yet not all stocks go down? Is it possible for the stock market to go down with not all stocks to go down with the stock market? And I'll tell you, the answer is yes, because the opposite is happening right now. The stock market has been going up, but not all stocks have been participating in the rally. There's certain stocks that have actually outperformed the marketplace. So, and there are a lot of stocks that have underperformed. And that is a term that we look for. It's called relative strength. What stock and what sector has been going up? If the S&P 500 is up 10% year to date, are your stocks up 10%, or are your sectors that you're in up 10%? In other words, is the financials, is the gold, silver, miners, GDX, or the subsectors, are they up 10%? Are they beating, or are they less than? Where is the strength relative to the benchmark market? We've seen biotechs outperform the overall market. And so if this seems like a little too much information, let me explain why it's valuable to you. Because if a sector has outperformed the benchmark market, we cannot, as traders or investors or a company, expect the market or that whole sector to continue to outperform the market day in, day out, month in, month out, year after year after year on average. There are a few exceptions, don't get me wrong, but on average, not all sectors will continue to outperform the market. There will be times where there's a disconnect. It's up to us to look for different opportunities, and that's why right now the energy sector, basically petrol fuel, not natural gas, petrol fuel. Petrol fuel is still an area that has an interest to me from the long side. Areas that have, I believe, are entering and should start to see a sell-off, and believe me, we've seen stellar moves, is in the biotech space. Also, areas that I think we should start to see an interest in sell-off will be broker-dealers. Now, keep in mind, we were very bullish broker-dealers back in November. And I'm talking about the Schwabs, I'm talking about ICE, I'm talking about NYX, I'm talking about CBOE, And I have plenty of videos and trades to give you for testimonial. Many of you probably saw me at the Traders Expo in November. We did a huge expose about transportation sector. We did a huge expose on the broker-dealer sector, and it paid off for us. Another area of interest that we had was in the semiconductors, and at the time, I was laughed at, and I'm not joking. And I'm not here to brag. I'm here to say that looking at seasonal tendencies of certain sectors can help us. There's a few clues that we like to look for. And the first clue is that if we're looking for trading opportunities, am I looking at an overvalued area that I could look for a bearish strategy? And in that sector, is it optionable? Are there option strategies that I could employ? And if we take a look at seasonal tendencies of the marketplace, like, for example, the SMH, if we take a look at the GDX, which is the gold miners, if we take a look at the biotech, if we take a look at pharmaceutical, if we take a look at all these different sectors, are there opportunities in there? And I'm here to tell you, yes. So before I continue with planning and scanning in stocks and sectors, I want to stick with this page here because I want to also go through, for our commodity traders, a little interesting side note. When we take a look, and I mentioned relative strength compares not just the Wells Wilder index. Relative strength compares one product to another. And what you're looking at is the 30-year bonds versus the 10-year notes. Up here is the actual spread chart on what we call the knob spread. Now, if you take a look what I've got lined up here, from the point of interest that the knob spread made this first low in January, that's the point of the low of the stock market. That's the point of that measuring point, let's call it. If you take a look at the measuring point across your line on the knob spread at 1301, we're not quite there yet, but bond spreads are 12.12 right now, the spread between the 10-year notes and the 30-year bonds. Interesting how they almost came all the way back to where they started at the beginning of the year. Where would the stock market go if it went back to almost where it started at the beginning of the year? That's very interesting because this actually does show that, while 10-year notes, they went down, they came back, they're almost at that they're still above their fair value or their starting point of where they began the year at. Look at the trading bonds, the 30-year bonds, I mean. The 30-year bonds are actually, if you take a look at this, and I'll just move this on over here because it's been a while since we've adjusted this chart. To me, go back over here, just moved it accidentally. There we go. Bonds are actually, if you take a look at where we ended the day on the 3rd, at this breakdown here on this daily chart, we were actually trading at 144.5, 144.15. We're trading at 144.11. Bonds are unchanged. The whole year of trading, bonds are unchanged. The knob spread hasn't really changed. It hasn't given us direction. And I'm going to tell you right now, I think that longer term, the bond boys do not believe that the stock market is for real and can maintain upside bias. In fact, if we take a little line chart and we draw a line chart, we've broken out of that. So I think as we enter the month of April, the funny thing is we have April 15th tax deadline time. We're entering earnings season, and there is going to be more cross currents, and I think it's going to be very important for us to stick around every Monday and find out what are the hot sectors and what are the hot markets. Because if the bond market couldn't go down when the stock market made newer highs, what would happen when the stock market makes a correction? And when is this big shift out of bonds going to occur? And I think one of the clues that we look for is in that knob spread. It's kind of important. Other changes this month that occur are the Japanese, the foreign currencies. And in the Japanese yen, we've had an amazing downtrend. We were bearish here. I started to get a little bullish here. I was wrong. I got stopped out with some small losses. But right now, on a weekly basis, I want to bring to your attention that we did hit an important critical support here. We formed a weekly doji 2 weeks ago. The high on this doji was 106.23. Last week, we closed at 106.30. We did form a weekly high close doji, which after a strong downtrend, we would typically find ourselves in a consolidation. which we've been actually in a consolidation pattern right here. The trend, the pace of price decline hasn't been all that significant, and the market's kind of based itself out. More importantly, in the Japanese yen, and this is futures, not Forex, the volume on this little rally, prices haven't gone up, but look at the volume. There was a massive amount of short covering and a change of opinion in the marketplace. One of the other amazing factors that I want to bring to your attention is starting the beginning of April, it looks like they began a couple weeks early here, but beginning in April, we start a little seasonal reversal. Seasonal strength begins coming into the beginning of April that lasts towards the end of May. So that does not mean we run out and buy Japanese yen today. It means that we look for intraday and we look for daily pullbacks against support and look to confirm buy signals. So I think that we might continue to see a range, at least come back, test this high, get up into the 110 range. It's not that hard of a call. But if we do see pullbacks that should be supported between 105, 103 to 105, we should not take out this low here, which was 103.44. So I'm going to put this in, and we're going to track this every week going forward for the rest of the month. But this level right in here should hold for the lows, and I think as traders we can lean against long positions in the yen. So it is a seasonal upturn. So that was one currency I wanted to discuss. The next currency I wanted to also discuss is the euro currency. It's interesting that the euro currency kind of stalls out. It's been kind of choppy. As you can see, my indicators have been choppy, but it held right against, at the end of the month, monthly support. I would have preferred to see the market come down at the beginning of the month and make a low at the beginning of the month and then go back up and try and test the highs. But as it is, the euro currency continued on a downtrend, and our weekly resistance continued to hold. For the month of April, it's still giving us a bearish outlook, and you do get a little reprieve or a pop in the market from the beginning of April going into middle of April. And so if you take a look at the commitment of traders report, so in other words, we should see some kind of spikes going into the middle to the end of April, and then after that, look out below again. Another wave goes down. And that kind of makes sense to me, not to get short in the hole, to look for rallies to sell against. So look what happened last week. The market did rally, and then it failed again. And if you take a look at the commitment of traders report, what's interesting is to see where are the speculators in this. Well, they were long, and they haven't been that right in this market. They've been short on the way up, okay? Then they finally went long the market, and I'm going to, this is the important thing about looking at seasonal analysis combined with commitment of traders report to find out, has the speculators been on the right side? Are they on the wrong side? And do they follow seasonality? And if they did, then this green would not be south of the zero line, it would be north. And as you can see here, the market tends to move up and then peaks out. That's when they went long. So they went long right into this area in here. Now they stayed long from around 132, and then they stayed long, and they stayed long, and they stayed long. And, that's the problem. They lightly bought, they stayed long, they added to longs, and they added to longs. They added to longs up here at 136. They stayed long, and the market went to 133. They added to their losers as the market went down here and generated a weekly sell signal. They stayed long as the market went to 132. Ouch. And then they kind of liquidated longs as the market went to 130. And then finally they went short at around 129.5, let's call it. So at 129.5, they added to their shorts. They stayed short, and so probably short from 129. What happened last week? The market rallied to about 131. So if you're short from 129.5 and it goes up to 131, you're out 150 points in the euro currency. You probably got stopped out. But no, they're stuck with their position. They're still staying with their trade. Commitment of traders report says they're still short. So what I suspect is you got another rally or so coming in the market, and then watch towards middle to the end of the month for rallies near monthly resistance against this level right in here, which is around 131.5 area. One more spike high up in there, and I would be more interested in sticking with the seasonal tendency of the market and seeing if the market can get up into this level, and then I'll be looking for sell signals. Just up between 131 and 131, let's call it 131.25. And I'm going to put that, and I'm going to leave that here for us, 131.24. And I'm going to leave that there. So there's kind of like an examination of some two currencies that I think are fairly interesting. Now let me switch pages here. And I'm going to my stocks page. So we've covered the overall S&P, the bonds, the currencies, euro, the yen. Now let's take a look at daily, weekly, and this should be a monthly chart. All right. So let's take a look at our daily and weekly charts real quick. Bear with me a second while I tee it up for us. I have three different time frames that I look at when I'm looking at trades: daily, weekly, monthly. All right, so in our planning and scanning event, we want to take a look at some of the names that appeared as a buy signal in the last week. And if we take a look at, first off, consumer discretionary, we had a couple hotels that popped into buy. Starwood Hotels. What does not interest me in Starwood is the fact that it was in a seasonally strong period of time, and it kind of falters out of favor for the next few weeks. So I wouldn't be interested in that. Marriott International, and it has the same type of pattern. So I wouldn't be quite too interested in looking at any opportunities in those two. But it's interesting to note when I run scans to see out of all the stocks that were generating a weekly buy signal, how many stocks are in the same sector. As far as consumer staples, we had no buy signals in the weekly. Energy, it was kind of an interesting note that we had Apache. And I want to take a look at Apache because, boy, I'll tell you what, look at this. This stock kind of cratered here on a daily chart. And if you can examine the fact that this stock is one that's fallen from grace. I mean, it was a $109 stock and went down to 72. And it is just now, at the end of March, it begins its seasonal ascent to the upside. And we ask ourselves, well, did it conform to seasonal weakness before? Answer, yes. Did it conform to basing out? The answer is yes. Does it begin a seasonally strong period, and is it now entering a buy? And when it entered a buy, was it on decent volume? I got news for you. This is some pretty strong volume over the last couple days. So what I would look for is on Apache is, as you can see, it's oil and gas exploration. I would look for it, and in fact, if you know my work, it's also a high close doji. So we generated a weekly buy, high close doji, but that was a pretty probably too much of a pop for a very short period of time, even though we did break out. I would look for a pullback at around 76.20 or so, and I'd have stops just slightly below the low of the, unfortunately for this situation, the last 4 bars, which would have to go all the way underneath this last swing low. But that's your initial. First off, you got to get filled. So I'd be looking for any snapbacks in between 75.5 to 76.20. Stops below 71.80. I think that's going forward. I like the volume action. I like the seasonality, and I like the fact that this is a stock that has fallen out of grace. And the seasonal aspect of the market, if we start to see people taking money off the table in certain sectors, they're going to start to go in other areas. And one of the areas that still remains in a seasonally strong period is energy. Actually, this is Noble Corporation, seasonally strong period of time. As you can see, the only problem I have here, it hasn't been entering, the volume wasn't really as great as Apache. So what we're going to do is right now, I just wanted to go through the remainder areas of the market. Financials, not much happened. Healthcare, not much happened. There wasn't all that many stocks, information technology, that generated a lot of new buy signals. In fact, there were only 19 for last week. So what we're going to do is we'll continue this throughout the day and the week, and I hope that our insights to looking at what stocks, what sectors, and what commodities are looking appealing. In order to figure out where things might go, we've got to figure out where things have been. So as far as planning and scanning, I hope you enjoyed that, and I wanted to make a quick announcement. We're starting a new event here for those that are interested in TTU, and if you would like to join us every Mondays for planning and scanning, we have an introductory rate, $48, and Butch is going to follow up with our trades that we do and our recommendations. Also, if you have an interest, we are going to have our annual seminar. It's focused on options and option strategies, and I'm bringing in a very good guy, a good friend, a good compadre that I think is one of the top-notch educators in the option field. His name's Dan Passarelli. This will be in Las Vegas, and if you have an interest there, we'll send you a link for that, and I think you'll find how to combine using seasonal tendencies and the succinct, or at least not succinct, but some of these ways of analyzing the market, these technical tools that you can use to help develop market direction sense and then apply the right option strategies. That's what we're focusing on this seminar. So I hope you found value in today's presentation. I look forward to seeing how the week and the month